Gold to me is one of my favorite investments for the next year or two or three. I think that for a lot of reasons, some of the things I was seeing, some technical, but a lot more fundamental and sort of groundbreaking in terms of the outlook for gold started developing last summer and have only progressed and built since then. And I think that's what we're seeing validated in the market.
From the NXT studio in Southern California, this is the Power and Market Report. I'm your host, Albert Liu. I'm joined today by Mike Larson. He's a senior analyst for Weiss Ratings and the editor of the Safe Money Report. He joins us today from Palm Beach Gardens, Florida. Mike, thanks for joining me for the first time on the Power and Market Report. How are you?
I'm doing great. Thanks for having me.
So, we've been sort of in each other's orbit for a little while. I'm glad to finally get you on the show. You are a writer, editor at Weiss Ratings, and I assume not everyone watching this channel knows about Weiss. So can you tell us about what you do there? This is an independent rating agency, and I think this is something that people should know about.
Sure, absolutely. Weiss Ratings as a company, we've been around for 4 decades plus now, just publishing a variety of newsletters. The Safe Money Report that I'm involved with in one form or another has pretty much been the longest standing, oldest publication that we have. Weiss Ratings, the company overall, also provides an analysis model that will evaluate stocks, ETFs, mutual funds, and so on. We cover, if you include all classes of mutual funds and things like that, we cover about 40,000 different, or issue ratings of about 40,000 different investments for investment ratings. So, is a stock a good buy? Is it not? And so on. And that, is a simple letter grade system between A and E. Depending on whether it's a buy, hold, sell, and so on. So it's designed to help individual investors just get an objective analysis of the technical and fundamental health of any of the companies that they're investing in. We also, on the bank or on the financial institution safety side, will rate the safety and soundness of banks, insurance companies, credit unions, and so on. So that's for the sort of the non-investor. But if you're looking, is this bank a safe place to put my money? Take out CD, so on, things like that. We do the bank safety ratings, investment safety rate, and then investment ratings in terms of buy or sell the stock and so on. So that's kind of the overall or overarching business of the company. And more recently, we've actually also sort of branched out into the crypto arena too. So that's kind of a new business line for us.
Mike, you've been around, or this company's been around for a very long time, but I would guess that as of about 10 years ago, the demand for independent ratings have gone up because of what we had with the CDO market, Moody's and S&P. I don't know if you guys rate those types of instruments, but in either case, still, I think the spotlight was shown on ratings agencies and how they earn their revenue and I guess the importance of independence. Did you see that? Did you see a surge in the demand for your product after the financial crisis?
Yeah, I mean, you're obviously right. When you look at a lot of the mortgage securities, so-called AAA securities that ended up collapsing in value, a lot of investors got swept up in that through the mutual funds and ETFs and things like that they own. It was a real shame, and our sort of reason for being is to try and give people, again, independent, non-conflicted. I mean, we're not getting paid by the companies or anything like that we rate. We're just using our model to evaluate underlying fundamental technical momentum, different factors that are involved in determining whether it's a good or a bad investment. And I think that, hopefully that model is valuable for people and helps just give them a little bit of extra reassurance about whether or not something that they own or something they're considering owning is a good investment or not.
You mentioned cryptocurrency ratings. It's not something I'm familiar with, and I know that that's not the group that you're involved with, but is quite intriguing and something that I think is really needed. But I'm wondering, to the extent that you do follow this, how do they go about rating cryptocurrencies? What things do they look at?
Sure. I mean, the cryptocurrency, the drive for the use of these currencies, the value of these as investments and so on. I mean, it really is kind of a wild, wild west type environment, a new industry, new area that, again, whether from an investment or sort of an adoption standpoint, there's a lot of players in here, some fly by night, some very solid on a fundamental basis and that have a lot of potential. So the idea was take the ratings model, that and try and just sort of bring some, shine some light on this dark corner of the universe and try and say, hey, there are some cryptocurrencies that make better investments or worse investments. There are some that see more adoption versus less, and so on. So the ratings model, some of the we worked for a long time, just kind of trying to see if we could come up with a way to provide independent, objective analysis of that. So that's what that project's about. We rate dozens and dozens of these of cryptocurrencies, and again, sort of the same scale, from A and on down as to whether or not they're being used widely enough, whether the technology behind them is sound, whether from an investment standpoint, the trends are positive or negative, and so on. So that's the general idea there. Again, extend that idea of let's provide independent, objective analysis, put the facts out there, and hopefully guide investors a little bit, and see if we can do it in crypto the same way we've already done it. Again, from sort of a banker or safety standpoint or investment standpoint, stocks, bonds, or stocks, ETFs, mutual funds, that kind of thing.
So, as an equity guy, Mike, you must look at this. It must be kind of foreign to you because I don't even know how they would begin to do this. I mean, certainly from a collateral point of view, if it's not backed by anything, that doesn't make sense. If there are no earnings, that doesn't make sense. So I don't know. Have you sort of lifted the veil and just asked the guys who are involved in this what approach do they take? More technical?
Sure. And we do have primers available on the website that kind of explain the basic premise of how this works and so on. So anybody who's interested can check that out, can get there through the Weiss Ratings website and see for themselves what's involved in the model. But I mean, again, the idea it's just to extend that sort of reason for being. Try and provide independent ratings on a new sector that a lot of people are interested in.
Okay, let's shift over to gold. You are not a gold bug. You're a generalist investor. I don't know if that's the terminology you like, but certainly coming from the resource gold sector, that's how I see you. You sort of take a broad approach. But you have warmed up to gold in the last year or so. Can you talk about why and what you see is coming?
Sure. I mean, gold to me is one of my favorite investments for, the next year or two or three. I think that for a lot of reasons, some of the things I was seeing, some technical, but a lot more fundamental and sort of groundbreaking in terms of the outlook for gold started developing last summer and have only progressed and built since then. And I think that's what we're seeing validated in the market. When you look at what's going on with the gold price, obviously, a very large surge in the last several weeks. I mean, you're talking $170 to highs we haven't seen for gold since going all the way back in 2013. And I think it boils down to four main factors, right? Number one is the negative interest rate environment or falling interest rate environment that we're in here again. We've had this Fed cycle where for 3 years, from December 15 to December of 18, the Fed was gradually raising interest rates. But all throughout that process, the ECB, the Bank of Japan, and so on, never really even got the process underway. And now they're talking about potentially newer stimulus overseas. The Fed is on the verge of, reversing course basically and starting to cut interest rates. So when you add falling interest rates here in the U.S., which is what's coming, and you're already seeing it in the longer term part of the bond market, now it's going to happen at the short end as the Fed cuts, plus deeply negative rates and a proliferation of negative rates overseas, that's fuel for gold. I mean, everybody says, well, why should I own gold? It doesn't yield anything. Well, a 0% yield beats the yield on about, I think I just checked it recently, there was about $12.9 trillion in corporate and government bonds worldwide that have negative yields. You're literally you're not just not earning interest, you're essentially paying it in a roundabout way when you buy these bonds. So in an environment like that, that's tailor-made and very supportive, tailor-made for and very supportive of gold. So that's one thing that I see. The second issue really comes back to what's happening in other asset classes. And one of the reasons gold has struggled is that there was a lot of faith and expectation that paper assets, things like stocks and so on, were going to continue to perform well. But now you're starting to see, ever since the January 2018 blow-off move in the S&P 500, we're seeing volatility gradually rising on each one of these sort of retests. We're seeing, again, credit spreads beginning to widen out. So that's the bond market saying, hey, there's more risk of default here, gradually rising. We're not at panic levels, but it's the direction that matters. So I think you throw that in along with the economic data, which is saying, the U.S. economy has been sort of sailing along just fine while the rest of the world in the last few years has had trouble. But now we're starting to see some real recession risk priced in here in the U.S. Not immediately, but if you look at what the bond market's doing, it's telling you this economy has a very good chance of falling into recession or getting close to it next year. So I think that all of that boosts demand for chaos insurance, for gold as a protection against the unknown and protection against the lost faith in paper assets. A third thing really goes back to the fact that a lot of assets have been inflated over the last several years by this easy money environment. And gold's one of the few assets that's actually undervalued when you have this ocean of overvalued assets. You look at the value of everything from real estate, commercial and residential, to stocks, to risky bonds, to things like artwork and collectibles, baseball cards, modern art, whatever, you name it. The valuations of all of these different kinds of assets have really surged in the last several years to the point where they're actually more stretched vis-a-vis the regular economy or GDP. The ratios there are the highest we've ever seen, including at the peak of the last two financial bubbles. Whereas gold, again, like we said, for multiple years was really sitting this out. So gold and gold stocks are arguably very cheap in this environment, and that's another reason why I think that the metal and metal-related equities have a lot of potential gains to go.
Mike, I guess since I've been following you recently, you've been negative on stocks. You've been opting for more safe plays. I'm wondering if we go into an easing cycle here. Are you going to shift that? Do you think that we're going to get away without having a major pullback, a major correction in stocks? And if so, are you going to be looking to get in there?
Well, sure. It's really interesting. Going up until January 2018, on each rally we had in the S&P 500, the internals were confirming it. We were seeing volatility make new lows with every S&P 500 new high. We were seeing credit spread, so basically the price of risk in the bond market falling on each successive high in stocks. And you were seeing pretty much all sectors participating. It was up until January of 2018, you had your offensive sectors, your growth sectors, things like financials, transports, materials, industrials, and so on and so forth. We're all moving right along to the upside along with the market. But what we've seen since January of 2018 is a real split behind the scenes. The Weiss ratings, again, we rate, if you split sort of dual listings out of it and so on, we rate just over 9,000 independent U.S. equities. And what I'll do is I'll look at the buy-sell ratio, how many equities we rate buy versus sell, and how that ratio has changed over time. What it does is kind of confirm the market internals. Is the market advance being, is it broad-based, or, almost all or most stocks participating? Or is the opposite true, where it's just a few names at the top of the heap that are doing well, but a lot of stocks are lagging? Up until that 2018 point, January of 18, our buy-sell ratio was confirming the market rally. What's happened at each successive minor high in the S&P is that ratio has been making lower lows. So we're not seeing as broad participation. And if you look at the S&P 11 sectors, what's been leading the market in the last year to 12 to 18 months? Utilities, real estate investment trusts, defensive sectors, consumer staples, and what's been lagging? All that stuff I mentioned earlier: transport, small caps, banks, the stuff that does well in weak to weakening economies, to recessionary economies. Those are all taking the lead, where all the ones that do best in strong growth economies are faltering. So a sort of long-winded way of saying, I think that the market still has to prove itself. I think that the move to safety, which in the case of the Safe Money Report, the strategies were to raise a lot of cash, to rotate out of growthy type names and into more defensive ones, and to start using opportunistic hedges from time to time to protect downside risk. That's what I've been doing since really the first quarter of 2018. It's been working out very well. I mean, if you look at the return for the utilities ETF, for example, it's up something like 23, 24% versus some of these sectors that are either flat to negative to up a couple percentage points. So that just shows you how big of a spread there is. To get back to what the Fed can do about it, everybody likes to point out, well, in 94, 95, the Fed made a pivot. It went from a hiking cycle to basically starting to cut rates and talking a lot more dovishly. And we had that proverbial soft landing in the economy. And the market, obviously, in the late 1990s did very well. The problem is, whenever anybody cites the 94, 95 cycle, they don't mention what happened in 89 to 91, where the Fed pivoted and the economy slipped into recession and the market went nowhere and had a 20% drawdown at one point for a long period of time. They don't mention in 2000, the early 2000s, where the Fed pivoted after hiking for a lot, but then we ended up with a disaster, the dot-com bust, and the S&P lost 50% of its value. And they don't talk about how in the mid-2000s, after the housing market started to cool, the Fed pivoted again. What happened? Great recession, 57% plunge in the S&P, and so on. So basically in modern history, going back to the end of the 1980s, there's been 4 different Fed pivots cycles where they've gone from hiking to cutting. One of them was bullish. The other 3 were not. So I think that it's, in my opinion, the market's kind of telling you and the bond market's telling you the Fed's probably too late. It's probably already sort of, by leaking some of the air out of this and setting the economy up for recession, it's going to be rough sledding. So that's kind of how I've been playing it for a long time. I think if we see confirmed, consistent new highs here, broader participation, our own internal data suggests that things are turning, sure, I'll change my view, but nothing like that's happened for a year and a half now. And so it's kind of, in my opinion, it's sort of steady as she goes.
I guess we'll see. You're going to be joining us in Vancouver as a featured speaker July 30th to August 2nd. I'm really looking forward to that. And I think it's going to be a very interesting story at that point because we're going to be coming off the July Fed meeting. People are looking at rate cuts at this point, quarter or half point. What would be interesting is if the market doesn't get what they're thinking, because when that happens, things get kind of wild. But either way, we'll have you with us, and it's going to be very interesting. Any last thoughts for the viewers, Mike?
Sure. I think that it's just important to remember the narrative is that the Fed is there to protect you. We've gotten very used to over the last several years that they've been able to sort of arrest the cycle when necessary. But now when you've had the longest economic expansion in U.S. history, or at least it will be as of next month, when you have basically one of the longest bull markets ever, you have all these excesses that have built up, and you're starting to see deterioration that's in the internals, coupled with a yield curve that has, basically flattened or inverted the most since it did before the last couple of recessions and bear markets. All of these factors are piling up and telling you that it's a different market environment. I mean, it has been for 12 to 18 months now, and nothing really has sort of changed to suggest that period of more worrisome or troublesome trading is changing. So as long as that's the case, I think you still have to play defense. Defense wins championships, as the saying goes, and I think that's true for your investing approach here. And obviously, one exception, in my opinion, is the gold market. I think that the possibility for gains there, given all those forces that I talked about earlier, and the fact gold has sat a lot of this out, I think the possibilities, again, the potential there is very, very high, probably the highest we've seen in a number of years.
You can learn more about Weiss Ratings at weissratings.com and follow Mike on Twitter at @RealMikeLarson. Mike, thanks for joining me on the Power and Market Report. Really appreciate it.
Great. Thank you.